Well, greetings if you're watching us online. And what we'll be doing today is going over chapter 9, pardon that noisy fan, and we'll be going over chapter 9. It's a fairly short chapter. It's about all at risk and quasi comprehend. So I think it will lend itself well to being online. Let me go ahead and share my screen here. So here we are. The chapter 9 outline, as you know, starts in a separate file. And I emailed you that file. It's also available on Canvas files. So chapter 8, assessing the risk of material misstatement. So this so-called audit risk that we're going to face, well, we're concerned really about the risk that our audit procedures won't find that material misstatement when it's out there someplace. Now, do you think we could ever say that there is a 0% chance that we will fail to detect that material misstatement? No. I mean, how many things in life have 0 risk? How many things in life have 100% risk? Extremely few. So we always have to give ourselves some wiggle room in an audit. So that's why we say things like reasonable assurance. There's always a chance that we could miss something. So let's look here at Roman numeral 1, just kind of an introduction to audit risk there. So as we know, auditors are required to obtain an understanding of the entity and its environment. So let's understand the specific organization, specific company we're dealing with, and also its environment. Just like if we were dealing with a brick and mortar retailer, we know its environment is really, really risky. If we were dealing with a lot of small private colleges, not Florida Southern, but with a lot of them, they're in a risky environment too. So if we went up north to one of the states where a lot of us are from, New York, New Jersey, Pennsylvania, Ohio, Indiana, Illinois, Michigan, there are a lot of small private schools. And yes, some have closed, just like we were discussing on Staten Island. St. John's University is going to be closing its campus there. St. John's being a Catholic school, and it's not a small school at all. But looks like they'll keep their Queens campus. That's the main campus. But a lot of small private schools have closed altogether. So we know the environment there, not too good. But Florida Southern, even though we're in that environment, well, we, as we think about the entity, are in really good shape. And I won't have any surprises tomorrow in my audit committee meeting here. So we need to know about those. We need to know about internal control. That's the part that we have good internal control here in Florida Southern. And that's to assess the risk of material misstatements in its financials. So how risky or how subject to material misstatements is this entity? Well, obviously, if it has poor internal control, if it's in an unstable environment, or if the organization itself is unstable, those all spell a lot of risk of material misstatement. So it's likely to have at least one material misstatement. And the higher the risk of material misstatement, guess what? The more audit work we must do. Delve into risk of material misstatement more in just a bit. But again, in a nutshell, it's just how likely it is for this entity to have material misstatement someplace. As an auditor, we would like to detect it, but there's never a 0% chance that we'll fail to detect it. Never 100% chance, in other words, that we will detect it. That's all. So to remind us, audit risk can never be 0 in practice, so never a 0% chance. we will fail to detect that material misstatement. So that's why auditors always emphasize reasonable, non-absolute assurance. Reasonable, a 90% some odd guarantee, but giving ourselves some wiggle room to give ourselves an out. But absolute assurance would be 100% guarantee that we're going to find that material misstatement when it's out there. Can never do that. Then C, auditors must distinguish between the risk of material misstatement and the overall financial statements. So the overall financial statement level versus the assertion level. Let me just compare and contrast the two for you. So first, at the overall financial statement level, this refers to risks which pervade the financial statement as a whole and could affect a number of transactions and accounts, as well as assertions for those accounts. Factors which may affect this risk include deficiencies in management's integrity or its competence, or ineffective oversight by the board of directors, inadequate accounting systems and records. Ooh, that's a big one. Declining economic conditions, again, just like a lot of small private schools, or significant changes in the client's industry, just like brick and mortar retailing. There sure has been a big monumental shift over the years, and that's toward online instead. So all those things pervade the financial statements. They make virtually everything, every account, every transaction in those financials more subject to material misstatement. Now, at the assertion level, so think individual accounts here. This refers to inherent risk and control risk. We'll study these more closely later in the chapter. For example, in the financials, if we think about cash, well, cash, how likely would you say, if there's no internal control over cash, how likely would you say cash is to have a material misstatement in it? Just about 100%. In fact, I'd say 100%. Because if there's no internal control, if nothing else, somebody's going to see that as an opportunity. And even though you think that employee is really honest, they may do what? Steal some cash. Don't tempt them. So more about those in a little bit. Or again, if there's poor internal control in an account, that says a material misstatement is much more likely. Cash being very liquid has high inherent risk. Just build into the account. We'll see what that is in a few minutes. Well, then D, the auditor always assesses risk, and the assessment procedures include the following. Whenever we're doing an audit, we're going to inquire management and others in the entity. So do you know of anything that is especially risky? Analytical procedures. If we see sudden changes in financial ratios over time, that could spell that we're looking at some fraud or some other misstatement. Observation and inspection. If we observe people doing their jobs and they're really not following what they should be in the way of internal control, that's a problem. Again, risk is more likely. Then number 4, discussion among audit team members. That's another thing we should do. We should always brainstorm and think what kinds of misstatements could occur. And then number 5, other risk assessment procedures. And these might include such factors as predecessor auditor comments because they know what's going on. Knowledge obtained from other engagements with the client, like if we did tax work for them and things weren't so good there, points out something. Non-routine transactions. You may recall from chapter 3 that non-routine transactions are almost always material. They're high risk because clients not used to doing them. Things like adjusting entries. Clients mess them up all the time. So that spells high risk of material misstatement and other knowledge we've gleaned about the client. Well, in E, the auditor will carefully consider fraud risk, as misstatements arising from fraud will be more difficult to detect than misstatements arising from errors in general, especially management fraud. And we bear in mind that a simple error has no intent behind it. But fraud can be covered up, especially management fraud. We'll see that more in the next couple of chapters. And as we know, fraud often involves intentional concealment, and this concealment can be very sophisticated. Again, very much as we go up the ladder in the company. The higher the level of fraud, the greater the potential for very sophisticated concealment. Well, the auditor will be very interested in how management goes about its own assessment of the risk of fraud. We always inquire about that. And management should be controlling fraud within the company. That's a part of internal control and a part of the accounting process, really. And the auditor will assess fraud risk at both the overall financial statement level and at the assertion level. Again, assertion level, account by account. And F, risk and materiality are very closely related. Risk is a measure of uncertainty, and materiality is a measure of magnitude or size, like how many dollars. And together they measure the uncertainty of amounts of a given magnitude. So we'll relate to that as we go through the chapter 2. Well, let's look here at identification of some significant risks. Well, significant risk represents an identified and assessed risk of material misstatement that, in the auditor's professional judgment, requires special audit consideration. And we'll see this in later chapters, that the auditor must obtain an understanding of internal control relevant to significant risks in order to perform the design and implementation of related controls. And the higher the risk that an account could have material error, like cash, the more internal control we've got to have over it. The auditor must also perform substantive tests related to the assertions, which are deemed to have significant risk attached to them. For example, if we see a lot of past due accounts receivable, we're going to have to increase the number of confirmations we send out to customers. We're increasing a substantive test there, especially a test of detail, and we may find a lot of deadbeats there that aren't going to pay the bills. Well, and B, significant risks often relate to, again, non-routine transactions, we said, are matters which require significant judgment. They're not cut and dried. And management often judges those in the best favor of the entity, namely to increase assets, revenues, and gains, and to decrease liabilities, losses, and expenses for obvious reasons. And any account that we see with fraud risk, we'll pour on the coals there. We'll audit it more carefully. Now, in Roman numeral 3, I'd like to go over the audit risk model. It's on page 269 of your book. I will simply put it up here on the board for you. And let's see. For those of you in class, if I put on that panel over there, let's see, Savannah, would you be able to see okay? You wouldn't, okay. Is there one of these I could put up, one of these screens? And if so, which one? You don't want me to put one up? Or should I put it on the sideboard? Sideboard? Okay, when it's, I think you'll be able to see it okay, Savannah. If you can't, just let me know. Okay. So what I'm going to do here, move this audit risk model. Let me point my computer here. Come back live. There in the book, we have an audit risk model that looks like this. We'll have something called PDR. You don't have to write this down. That means plan detection risk. We'll go over what that means in a moment. But it equals this. AAR, meaning acceptable audit risk, times CR times IR, control risk, inherent risk. Again, we'll see what those are in just a bit. Now, I also, as I go over this, like to chart out the relationship of each risk to the amount of evidence gathered. Take them in this order: plan detection risk, I'm going to acceptable audit risk, then to control risk, and inherent risk. And if you're watching us online, can't see something, I will make sure that I get a close-up as class ends today, so you can always see what I mean. Okay. So let me take this back, my computer back to the podium, that is. Let me go back, sharing my screen. There we go. So this audit risk model here. Well, the audit risk model, what is it? Well, it's a planning model to decide how much evidence to gather. And it's not subject to precise calculation. But the amount of evidence is always a judgment call, of course. So the audit risk model gives the auditor a framework to justify and defend this decision. So you'll find that there's no way to calculate, for example, the exact amount of accounts receivable that we must confirm. That's up to the auditor's professional judgment. So there's an answer on the CPA exam again, as we know. But should the auditor increase the number of confirmations or decrease the number of confirmations? That's what the audit risk model will help us decide. So it's a general guideline. It's not precise. Does that make sense? So it gives us a framework so we can justify and defend our evidence gathering decisions. As you'll see. Well, the auditor will assess acceptable audit risk, inherent risk, and control risk, which are the independent variables, to arrive at plan detection risk, which is the dependent variable. So you may recall in an arithmetic model that independent variables exist in nature, so to speak. They're just out there. You put them together in the arithmetic model to arrive at a dependent variable. In other words, dependent upon the arithmetic model. In this case, it's a fraction. The arithmetic model in which we plug in the independent variables, and then we arrive at PDR, plan detection risk, the dependent variable. Does that make sense? So let's think about what plan detection risk is, PDR. Well, it's the risk the audit evidence will not detect a material misstatement, given that the misstatement exists. So it's out there someplace. What's the risk that we won't detect it? It's never zero. It's inversely related to the amount of evidence to gather. Thus, more evidence gathered will lower plan detection risk. Less evidence gathered will increase it. I think that makes sense because if we gather more evidence, we probably will find that material misstatement. If we gather less evidence, we might not find it. So that's why we say an inverse relationship. And again, since plan detection risk is a dependent variable, its value is dependent upon the independent variables in the model. And it's rather like type 1 error for a material misstatement. You may recall in stats that type 1 error is when your sample says everything's okay. In this case, sample of evidence we gather in the audit. However, had you been able to examine the entire population, you'd find population's not okay because there's at least one material error out there in this case. So as I go through these risks, let me go ahead and look at the relationship to the amount of evidence to gather. So in this case, plan detection risk has an inverse relationship to evidence. Let's start enumerating and several risks. I'm sorry, if you're online, I forgot to stop my share. Let me show you this better. If you see it, probably wonder what that was. All right. So again, plan detection risk. There's an inverse relationship in the amount of evidence gathered. So if we would like to decrease plan detection risk, that means we're going to have to gather more evidence. That makes sense intuitively. Because the more evidence we gather, the more likely we are to detect a material mistake. Or I should say, let me word it like this: more evidence we gather, the less chance that we fail to detect a material mistake, given that it's out there. That's what PDR is. By the way, for a high-risk client, like an SEC company, we want to accept very little plan detection risk. Now, let me share once again. And we'll look at our next variable. And it's one of the independent variables in B. So it's plan detection risk, PDR. And that's the risk that all that evidence will not detect a material. Whoops, I'm sorry. Oh, backtrack. Let me look at one of the independent variables, inherent risk, IR. That's down in the denominator. And what that is the auditor's estimate. The material error exists in an account, assuming no internal control. Since internal control is considered under control risk in a moment. But IR is usually higher for accounts which are liquid, have many transactions, or which are larger in dollar size. And also depends on some factors on pages 276 through 77. Just read those on your own. They're very easy. But again, things like how liquid the account is, or how likely the account is to suffer from fraud, or how much judgment is required to account for that account. And if there's more judgment required, if the account's more liquid, etc., that spells high inherent risk. So high cash, definitely not guarantee 100%, because there's no internal control over cash. There will be a misstatement. Someone will walk away with some. Accounts receivable have a lot of inherent risk. Inventory does too, especially merchandise inventory and retailer. It has a high risk of damage and obsolescence and a theft. Adjusting journal entries, again, clients tend to mess them up if they even make them. It's a non-routine transaction. Now, very low. Most property, plant, and equipment, especially land. Land has probably the lowest inherent risk of any account. And the reason is that it's just not going anyplace. There are not many transactions going into it, and I'm not sure how you really have internal control of land, except maybe fence it in, or maybe make sure that you don't buy land in a sinkhole zone, which is something you really need to look at in Florida, especially here in Central Florida. Yes, I evaluated that very quickly and carefully before I bought my house and my own rental house here in Lakeland. I was very careful about that too. Capital stock, that's something else, especially if it's old issue. Something with very, very low inherent risk, because we all did that last year, quite frankly. And we know exactly how much stock sold for. So how many shares sold? Cut and dried. So with inherent risk, as I get off my shared screen and go back over here to the board. Fine. There. Tolerate a lot of statement because we want to audit cash very completely, very carefully, very precisely. We usually do so. We count the client's currency they have on hand and convert it in cash on deposit with bank. So we want to do that. Such high inherent risk, plus first thing on the balance sheet. An account with low inherent risk like land, we have a very low evidence value, especially if it had been purchased sometime in the past. So again, direct relationship between inherent risk, and there a lot of evidence, inherent risk is high, gather low evidence if inherent risk is low, like overlay. Correct relationship. Now, let me come back here to the outline. I'll share my screen with you if you're online. So if we look at the other thing in the denominator, that's control risk. CR. It's the risk that internal control will not prevent and or detect a material misstatement. So if internal control is not working, control risk is very high. If in doubt, in fact, set control risk at the maximum of 100%. That's just kind of a default value. In fact, if control risk is set below 100%, the auditor must document why by evaluating internal control and conducting test controls. By the way, a little note there, poor management integrity can affect control risk, as management will be less likely to institute and enforce good internal control. They're probably busy bypassing it themselves. And that means they'll be more likely to bypass or override internal control. Quite frankly, poor management integrity also spells higher inherent risk. Really every account. So that's the assertion level. So let me come back. Stop sharing my screen. I look back over. Sideboard here. For an account with high inherent risk, that's where internal control is not working. How much evidence do you want to gather? What? For an account with low inherent risk, there's a payout for the company. Probably you can gather less evidence because probably the account balances are already fairly stable. So we have a direct relationship between control risk and the amount of evidence gap. That makes sense. Yeah, if you're online, a few minutes, I'll zoom in on that sideboard. Let me go back sharing my screen. Well, then E, we can note the denominator of the model, in other words, inherent risk times control risk, is the expectation of misstatements in a particular account after considering internal control. And we also notice that both inherent risk and control risk are both inversely related to plan detection risk and therefore directly related to the amount of evidence gathered. Thus, if either inherent risk or control risk is higher, the auditor is going to gather more evidence. Lower, the auditor gathers less evidence. And by the way, both inherent risk and control risk can very much one account to another. So in addition to evaluating them at the assertion level for all accounts, we also need to evaluate them at the specific, whoops. Just make sure my terminology matches up with the book. Hang on just a second. So if I use one term and CPA exam uses another term, you might get confused. Okay. Let me come back here. So both inherent risk and control risk can vary a lot from one account to another. So we must evaluate them at the assertion level, or in other words, individual account level. We must also evaluate inherent risk and control risk at the overall financial statement level too, because they can pervade all the accounts. On the other hand, they can vary a lot from one account to another. Now, number two, for accounts with high inherent risks, such as cash and merchandise inventory, it's a good idea to have low control risk through good internal control. And conversely, internal control may not be as stringent over accounts with low inherent risk, such as land. We can explain both these by the product of inherent risk and control risk. We want that denominator to be as low as possible. Because once again, that denominator represents the risk material misstatement in a particular account. Now, if you're online, let me go back to the sideboard. Stop my share for a moment. So, as I said, if we think about inherent risk times control risk equaling risk of material misstatement. Risk of material misstatement, obviously, a direct relationship to the amount of evidence gathered. So the higher the risk of material misstatement in a particular account, it makes sense intuitively, the more evidence we've got to gather. Further makes sense if we think about the two components of risk material misstatement, inherent risk and control risk. Again, the higher they are, the more evidence we must gather. I'm going over this carefully because trust me, in the CPA exam, they expect you to know these relationships, the amount of evidence gathered. And they know, again, under test pressure, how many people are going to mess it up? A lot. People tend to with things like this. Now, I just have one left to go. It's AAR. Let me go ahead and write it inverse on it. So the lower it is, the more evidence we must gather, or vice versa. By the way, sometimes I've had people call an inverse relationship an indirect relationship. That's not the case. No, inverse is a very specific type of relationship. It's the opposite of a direct relationship. Indirect implies this depending on something else. That's not what it is. Okay. So if you're online, let me resume my share again and come back to the handout. So in F, here's that acceptable audit risk. It's the subjectively determined risk, so the auditor's judgment again, that the auditor is willing to assume that the financial statements are not fairly stated in all material respects and the clean opinion was issued. That's analogous type 1 error for the audit opinion. So the evidence, the sample of evidence that is, we gathered said everything's okay. But had we been able to examine the entire population of evidence, we would see, nope, everything's not okay. There's material error out there. So we issued a clean opinion when we should have issued something less. Again, we can know it can never be zero because the auditor cannot guarantee freedom from misstatement. We also note the acceptable at risk is directly related to plan detection risk and therefore inversely related to the amount of evidence gathered for a mathematical explanation. Thus, if the auditor is willing to accept a higher acceptable at risk, gather less evidence. Willing to accept a lower acceptable at risk, gather more evidence. I'll tell you why in a moment. But acceptable at risk does not vary from one account to another because it relates to the opinion issued, and that's on the overall financial statements. And the auditor will state his or her assessment of acceptable at risk for the audit in the working papers as a part of planning documentation. And acceptable at risk is sometimes called audit assurance. And again, I like to use terms they may use on the CPA exam. We're talking about the same thing, but sometimes they change up their preferred terminology. So even if we're talking about the same thing, if you don't know their term and you see it under test pressure, you'll think, oh my gosh, we never covered this. I don't know why it is. Not a good feeling. Then G. Engagement risk is another risk concept, but it does not appear in the audit risk model. Engagement risk is the risk that the auditor will suffer harm as a result of the audit, even though the audit report was appropriate. Engagement risk partly depends on how likely the client is to fail after the audit. It's called higher engagement risk. It's also based on the extent to which users rely on the financials for information. So more users, higher engagement risk. Thus, greater engagement risk is indicated by publicly held versus privately held clients. A lot more people involved in publicly held. Poor versus good financial health. Large versus small client. Greater amounts of debt and equity securities. Poor management integrity also indicates greater engagement risk, to tell you the truth. And engagement risk may be factored into the model by lowering acceptable at risk. Also, audits with high engagement risk as well as high risk material misstatement may require more experienced audit staff or may be reviewed more carefully. So that explains why the auditor may decide on a higher or lower AAR, it's engagement risk. So like a publicly traded client, SEC client that is, we want to accept low AAR, gather a lot of evidence. On the other hand, a small mom and pop company, privately held, no big risk factors, we may increase AAR. It's safe to do so. And therefore, we give mom and pop a break. We don't gather as much evidence. They can't afford a big audit bill. And finally, here in the chapter, relative risk is another term which you'll sometimes see. Just means an account has greater relative risk than another account if it's larger, if it's more material, or if it has higher inherent risk or higher control risk. Thus, more evidence usually gathered for accounts with high relative risk. And let me unplug my computer here. For those of you online, I'm going to walk on over to the sideboard. All right. That's our young line. Just make sure you can see everything here on the sideboard that I will. Somehow, though, I don't think I've ever had a student this small. Well, shoot, other people just don't like it. Is intriguing because of me to shut them down. Hey, it's one of the barriers to entry. And oh, I want something fun. Accounting's not for me. Plus, it's difficult. It involves high level math. Plus, those accountants are nice. Well, we'll have the last one. Are we willing to endure all those things? Yeah. Plus, we know those things aren't as bad as other people. Not all. Any questions or anything? Well, it's chapter 9. It's not bad. We come back from fall break on. And so what I will do then is on Monday of next week, I'll start talking there about chapter 10. And again, the chapter 10 handout is in this file, same file, which I'll email to you. Chapter 10 will start us off on thinking about fraud and some more depth. We'll see more specifics about fraud. It'll be an apparently interesting chapter, I think. All right. So have a good one. I will see you back on Monday of next week. And let me know if you ever have any questions. Always glad to help.